Welcome to Tech Money Madness, your daily U.S. stock market deep dive, June 12, 2026.
Hey, everyone.
So today, $75 billion practically vanished from the Earth and, well, went straight into orbit. And the biggest artificial intelligence companies in the world basically paid the price.
Yeah, they really did.
We're looking at a market that is actively rewriting its own rules right in front of us. I mean, between a massive S&P 500 rally triggered by global energy relief, the historic launch of SpaceX onto the public markets, and just a brutal reality check for legacy tech giants, the definition of what makes a stock safe is completely shifting beneath our feet.
Completely shifting.
Right. So for you listening, whether you are managing a massive portfolio or just trying to wrap your head around why your index fund suddenly spiked today, we are going to cut through the noise and explain the actual mechanics driving this chaos. Okay, let's unpack this.
You really have to look at the market today as a massive interconnected plumbing system. Like, you cannot understand why established software stocks suddenly cratered this afternoon without understanding the mechanics of the aerospace sector's big debut.
Right, the SpaceX thing.
Exactly. And you can't understand either of those things without first looking at what happened to the price of crude oil overseas.
So let's start at the source of that plumbing system, right? The macro setup. The S&P 500 staged a very aggressive rally today. And the underlying foundation for all of this risk-taking actually started with the headlines regarding the Iran peace deal. We saw global oil prices break down below $85 a barrel.
Yeah, the market essentially prices in what we call a geopolitical risk premium.
Okay.
Think of it as an invisible tax tacked onto every single barrel of oil traded globally, just in case a regional conflict disrupts supply lines. So when a peace deal looks probable, that invisible tax just vanishes overnight.
Oh, wow.
Supply lines look secure, speculators dump their defensive positions, and the price per barrel mechanically drops. It's just math at that point.
Wait, but why does the Federal Reserve base so much of their market signaling on oil? Because I always thought, the Fed focused heavily on core inflation, which specifically strips out food and energy because those sectors are so volatile.
That's a great point.
Like, why does crude dropping below $85 suddenly make Wall Street think the Fed is going to back off on interest rates?
Well, core inflation does strip out the direct cost of gas at the pump, sure. But the Fed knows they can't ignore the indirect costs. I mean, oil is essentially the baseline operating tax for the entire global economy.
Right, it's in everything.
Exactly. Every piece of plastic packaging is derived from petroleum. Every server rack in a data center was transported by a diesel truck or a cargo ship burning heavy fuel.
Yeah.
When oil stays high for a sustained period, shipping companies raise their rates, manufacturers increase their wholesale prices, and eventually that bleeds right back into the core inflation metrics the Fed actually tracks.
So when oil drops, that entire supply chain just breathes a sigh of relief. The underlying cost of doing business gets cheaper.
Yes. And the chain reaction from that relief is what drove today's S&P 500 rally. Because if overall inflationary pressure is cooling off because energy is cheaper, the Federal Reserve doesn't feel the need to step in and aggressively hike interest rates, to cool the economy down.
They can just let it run.
Right. The market sees that looming threat of expensive borrowing costs lifting. And when capital isn't terrified of a sudden Fed rate hike, it stops hiding in defensive assets like Treasury bonds. It feels brave.
It goes hunting for growth.
It goes hunting for high-yield growth, yeah.
Which, honestly, makes the current S&P 500 earnings forecast look almost suspiciously optimistic. I mean, we are looking at a projected 22% earnings growth for 2026 and another 15% for 2027.
Massive numbers.
Massive. And driven overwhelmingly by the build-out of AI infrastructure. It feels like this energy price drop acted as a massive pressure release valve for the entire U.S. economy. But is that macro relief genuinely enough to justify taking on these kinds of massive new risks?
What's fascinating here is how incredibly fragile this foundational optimism actually is. I mean, a 22% average earnings growth across the S&P is a spectacular number. But this entire macro setup is entirely tethered to daily headline developments.
Because of the oil reliance.
Yeah, if negotiations break down overseas and oil ticks back up to $95 a barrel, that pressure valve closes instantly. Borrowing costs look scary again, and those high-growth forecasts start to look like a huge liability.
But for today, it held.
For today, that risk premium vanished, and the capital markets were feeling incredibly bold.
Bold might be the understatement of the decade. Because capitalizing on this brave, risk-on environment, the market just witnessed one of its biggest liquidity events in modern history.
Oh, absolutely historic.
Ticker symbol SPCX SpaceX made its historic NASDAQ debut today, and the numbers are almost hard to comprehend.
It was the undisputed center of gravity for the entire trading session.
Okay, let me just give you the numbers. They offered at $135 a share. It closed at $160.95, which is a 19% jump on day one, peaking during the session at $161.33.
Just incredible action.
But it's the sheer volume that is blowing my mind. They sold 555.6 million primary shares and raised a staggering $75 billion in a single day.
And, the retail demand was unprecedented, sure, but we have to look at the institutional mechanics of a launch this massive. The market only has a finite amount of liquidity on any given day.
Right.
To understand the ripple effects, you really have to picture the total available risk capital as a water table.
Oh, I love this analogy. Okay, so if the market is a finite water table and you drop a $75 billion sponge like the SpaceX IPO into it, the water level for everything else in the market has to drop. It's just physics. That money cannot be in two places at once.
And we saw that mechanical drain happen in real time across the trading floor because institutional portfolio managers don't just magically summon new cash to buy into a historic IPO.
They have to sell something else.
Exactly. To secure their allocation of those 555 million SpaceX shares, they had to actively liquidate their current holdings. They were selling off established tech positions to free up the cash required to buy SPCX.
So this mega IPO fundamentally pressured other big tech names.
It forcibly shifted the market's entire center of gravity.
It's acting like a financial black hole, literally sucking the oxygen and capital away from adjacent sectors. But it feels like it's more than just a mechanical capital drain.
How do you mean?
Well, the enthusiasm for SpaceX feels like a fundamental shift in the type of growth investors are looking for. We spent the last decade obsessed with software updates and app ecosystems, right?
Right.
Now, the biggest liquidity event in history is funding physical rockets and orbital infrastructure.
It is a profound narrative shift. Investors are flocking to SpaceX because it represents a return to tangible, monumental engineering.
Physical things.
Yes. We're moving from a period where growth was defined by digital scale, acquiring millions of users for a new app, to a period where growth is defined by physical infrastructure scale. It is a generational pivot in where risk capital feels most comfortable living.
So $75 billion gets locked up in space. You check the broader market to see who paid for that ticket, and you immediately see the crater left in traditional software.
Oh, it was brutal.
There is a violent rotation happening right now. Money is fleeing software at an alarming rate and pouring into compute infrastructure and physical hardware. The legacy software sector got absolutely hammered today with broad losses of 10% or more.
Just massive sell-off.
Top losers included massive entrenched giants like Adobe, ticker ADBE, and Oracle, ticker ORCL.
A 10% single-day drop for legacy companies of that size is a severe warning siren. I mean, for years, the narrative was that software companies were the ultimate beneficiaries of AI because they could integrate smart features into their existing products and charge a premium.
Right, tack on an AI fee.
Exactly. But the market woke up today and started seriously questioning the underlying valuations of the traditional software business model.
Why the sudden panic, though? Companies like Adobe and Oracle have deep moats and massive enterprise client lists. It's not like they're startups.
The fear is that generative AI doesn't just improve software, it fundamentally commoditizes it. We need to look at how these companies actually make money. Legacy software as a service, or SaaS, is primarily valued on subscription seats.
Okay, yeah.
It is a headcount game. If an enterprise client has 1,000 employees in their marketing and accounting departments, they need to buy 1,000 individual software licenses from companies like Adobe or Oracle.
Ugh, I see where this is going. If an AI agent can write code, generate marketing images, and manage databases, that completely changes the headcount math.
Drastically.
Yeah.
If generative AI allows one human worker to suddenly do the output of 10 workers, that enterprise client doesn't need 1,000 software seats anymore. They need 100.
Wow.
They're going to cancel 90% of their licenses. The entire recurring revenue model that props up these massive software valuations starts to crack. The moat around these legacy companies suddenly looks incredibly shallow.
So that's why capital is violently rotating out of the software layer and digging down into the foundation, the physical compute infrastructure, making the AI possible in the first place.
Precisely.
Which brings us to the semiconductor space, which showed broad strength today, riding that exact infrastructure build-out narrative. Because everyone needs the physical chips to train these models. But there was a glaring, almost shocking exception today.
Yeah, there was.
NVIDIA, ticker NVDA, the absolute reigning champion of the AI boom, slipped today.
NVIDIA is facing a brutal convergence of headwinds right now. I mean, the first was the mechanical liquidity drain we just talked about. Portfolio managers selling off portions of their massive NVIDIA gains to fund their SpaceX purchases.
Right, taking profits to buy rockets.
Exactly. The second is an immediate supply chain issue. Rising memory costs are starting to actively compress NVIDIA's profit margins. But it is the third issue that is sending shivers down Wall Street's spine.
The hyperscalers?
The hyperscalers.
Yeah.
The massive cloud infrastructure providers, Google, Amazon Web Services, Microsoft Azure, they are the ones buying hundreds of thousands of NVIDIA chips to build out their data centers.
They're the biggest customers.
Yes. And they're starting to aggressively design and deploy their own bespoke in-house silicon chips.
Hold on, I have to stop you there. NVIDIA's moat has been treated as impenetrable for the last 3 years. NVIDIA has been the ultimate shovel seller in the AI gold rush, but what happens when the biggest miners like Google or Microsoft start 3D printing their own shovels?
This raises an important question. How sustainable are your profit margins when your absolute biggest customers realize they have the capital to become your direct competitors?
It's a terrifying prospect for NVIDIA holders.
It is, because NVIDIA doesn't just sell a chip. They sell a general-purpose processor surrounded by a proprietary software ecosystem. To justify their massive price tags, they rely on a metric called total cost of ownership.
Essentially arguing that even though their hardware costs a fortune up front, it is the most reliable and universally adaptable over a 5-year lifespan, making it cheaper in the long run.
Correct. But a hyperscaler like Amazon doesn't necessarily need universally adaptable chips. They know exactly what specific AI workloads their cloud customers running.
Oh, interesting.
So instead of paying a massive premium for NVIDIA's general-purpose chips, they hire a team to design an application-specific integrated circuit, an ASIC.
A custom chip.
Right. They build a chip that only does one specific math equation perfectly, and they send that design directly to a foundry in Taiwan to be manufactured. By doing that, they completely strip out the massive middleman profit margin that NVIDIA charges.
Man, so when the largest buyers in the world start building their own supply, the core thesis of NVIDIA's sky-high valuation comes under immediate threat.
Exactly.
So if software stocks are crashing because AI is breaking the subscription seat model, and the hardware kings like NVIDIA are seeing their margins threatened by their own mega customers, where on earth is the safe money going?
Good question.
Especially while SpaceX is happily absorbing all the high-risk, high-reward capital in the room.
Well, investors who still want tech exposure but are terrified of the rapid commoditization in the AI space are retreating to the mega-cap fortresses. Though, to be clear, even the fortresses took some minor structural damage in today's rotation. Both Apple, ticker AAPL, and Microsoft, ticker MSFT, slipped a bit.
Yeah, the briefing we are analyzing noted that Microsoft slipped primarily as a victim of that mega IPO capital drain we talked about, mixed with a broader market rotation where investors took some profits out of tech and moved them into traditional value stocks.
Right.
Apple, on the other hand, slipped amid signs of fading conviction in megatech overall, paired with concerns over their somewhat slower, more cautious rollout of AI features compared to their peers. But despite the daily slip, the briefing continues to paint Apple as a highly defensive, safe harbor play.
And that's because Apple's defense strategy has never been about having the absolute bleeding-edge experimental technology on day one. Their defense is rooted in sheer brand dominance and, crucially, their recurring services revenue ecosystem.
Here's where it gets really interesting. Apple services revenue, the 30% tax they take from the App Store, the Apple Music subscriptions, the iCloud storage fees, it acts like an impenetrable financial fortress.
It really does.
It essentially insulates them from the chaotic volatility of the AI arms race. It mechanically does not matter to Apple whether Google, Microsoft, or OpenAI wins the underlying AI model war.
Because whoever wins still has to deliver their product through an iPhone.
Exactly.
Yeah.
And Apple is still going to collect their toll on the software reaching 1 billion pockets.
It is the ultimate sticky, recurring revenue. They own the distribution channel, which makes the specific advancements in AI practically irrelevant to their baseline cash flow.
Wow.
And the other safe harbor the briefing highlighted today is Alphabet. They currently maintain a staggering 90% market share in consumer search, while simultaneously running a rapidly growing enterprise cloud business.
So Alphabet is being positioned as a safer way to gain exposure to AI without taking on the existential risks facing pure software or hardware companies.
Yeah, exactly.
Are they effectively just playing both sides of the fence? Like they have this absolute monopoly in consumer search that acts like an ATM, generating the massive free cash flow required to fund their infrastructure. And then on the other side, they're selling the cloud computing power that the rest of the enterprise AI world desperately relies on.
That is exactly how the mechanics of their safety work. Companies with existing monopolies, like Alphabet with search, or entirely closed hardware-software ecosystems like Apple with services, offer a critical buffer.
Right.
When the market panics, capital hides in businesses that generate cash regardless of who invents the next big microchip. They are insulated against the sky-high valuations and speculative risks we are seeing in the pure-play AI sector or in frontier tech ventures like SpaceX.
Which brings us to the most critical tension in the market right now, valuation concerns. We have covered a lot of ground today: the geopolitical relief lowering oil, the massive liquidity vacuum created by SpaceX, the violent rotation destroying legacy software, and the hyperscaler threat to hardware margins.
It's been a busy day.
Really busy. But hovering over all of this is the math of what these companies are actually worth.
Valuations are the ghost haunting this entire market rally.
Okay, I have to ask you to make this make sense for me, because there is a disconnect here. We established earlier that S&P 500 earnings are genuinely forecasted to grow by a massive 22% this year and 15% next year.
Right.
Those are boom time numbers. So why is everyone so terrified of these valuation multiples? Are analysts just looking for reasons to panic, or is the math actually breaking down?
If we connect this to the bigger picture, the fear is deeply rooted in the concept of margin for error. Yes, earnings across the broader market are growing, but individual tech stocks are currently priced for absolute perfection.
Perfection.
Absolute perfection. When we talk about a high valuation multiple, let's say a stock trading at 50 or 60 times its expected earnings, what that mechanically means is that the current stock price already assumes a company will execute flawlessly without a single setback for the next 10 years.
So the current price is pulling a decade of future success into today's valuation.
Precisely. The market isn't just betting they will succeed. It is betting they will dominate. And as we saw with the software sector's brutal 10% drop today, the moment that narrative shifts, the moment there is a single crack in the armor or a slight hint that AI might disrupt their subscription model, the market violently reprices them.
Because the perfection is gone.
Right. A 22% average earnings growth is fantastic for the index, but if a specific tech company's stock price requires 40% year-over-year growth just to justify its current multiple, that is an incredibly dangerous neighborhood to live in.
Yeah.
If they only deliver 30% growth, which is still objectively amazing, their stock will crash because they missed the perfection priced into the multiple. That is why this rally is fundamentally fragile.
Man. When you look at the board today, the geopolitical tension easing, SpaceX pulling $75 billion of liquidity out of the room, and traditional SaaS models taking a brutal beating, it all points to one massive reality check.
It really does.
The definition of safe tech is changing right before our eyes. The fortresses of the future are no longer just the companies writing the code. They are the companies controlling the sticky consumer services, the monopolies generating baseline cash, and the massive physical infrastructure powering the entire grid.
And I think the vital thought we all need to walk away with today is about the physical reality of the future market.
How so?
Well, for 20 years, tech investors were told that software eats the world and that physical hardware was a low-margin trap. But today, as $75 billion of risk capital rockets into space ventures, and as massive cloud providers spend billions manufacturing their own physical silicon chips, the paradigm has flipped.
Completely flipped.
Right. So what happens to the legacy tech companies that do not own a piece of this new physical infrastructure? If the future of exponential growth is hardware-dominated and energy-intensive, will the purely digital players be permanently left behind?
So what does this all mean? It means the AI narrative is maturing. That's all for today's Tech Money Madness Deep Dive. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.